Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. Happy first of the month. On the first day of each month, we review the book of the month. In order to be considered worthy a book of the month, a book has to meet a very simple criteria. It has to be impactful enough that it will either change your life or your perspective on the world. Now, whether it does or not, of course, is entirely up to you. If you consume it as a piece of entertainment, well, you're missing the point. But if you internalize its messages, you've got a realistic shot at lasting growth. Our book this month is absolutely worthy a book of the month. It's a book called 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation, and it's by Andrew Ross Sorkin. Sorkin is best known for his book called Too Big to Fail, his account of the 2008 financial crisis. In that book, he goes into a lot of detail, the elements that led to the banking crisis and the financial crisis in 2008. Now, in this book, he goes back nearly 80 years to examine the most famous market collapse in American history. Most people know the basic outline. The stock market rose dramatically during the Roaring '20s. There was a ton of speculation that took hold, and the market crashed in October of 1929, followed by the Great Depression. But knowing the outline is not the same thing as understanding what happened. The author's strength is narrative. He takes a complicated financial event and tells it through the lens of people who experienced it. The bankers, the traders, the politicians, the regulators, the journalists, and ordinary investors. They appear not as distant historic figures, but as human beings operating under pressure. The book's central lesson is not simply that markets can fall. Everyone knows that. The deeper lesson is that intelligent, experienced people can see the warning signs and still fail to act. So why is that? Well, it's because the incentives of the moment are often stronger than the consequences of the future. During the boom, rising prices appeared to validate every optimistic assumption. Speculators became wealthy, bankers extended more credit, political leaders celebrated prosperity. Anyone urging caution risked appearing foolish or outdated or opposed to progress. That dynamic should feel familiar. Every financial bubble develops its own vocabulary, but the psychology is remarkably consistent. This time is different. The old valuation rules no longer apply. Technology's changed the game. Demand is unlimited. Prices might look high today, but they'll seem cheap tomorrow. Eventually, confidence itself becomes a form of collateral. The danger is not the optimism. Productive investment requires optimism. The danger begins when the optimism replaces the underwriting. And for real estate investors, that distinction matters. A rising market can conceal weak execution. It can conceal excessive leverage or unrealistic rent assumptions. When values are increasing, nearly every decision appears intelligent. Refinancing can rescue an underperforming business plan. A sale can cover construction overruns. Appreciation can hide weak cash flow, but appreciation is not a business plan. One of the most important themes in the book 1929 is leverage. Investors were not merely buying assets they believed would rise. Many were buying those assets with borrowed money, and that magnified the returns on the way up, and it accelerated the losses on the way down. Leverage is neither good or bad. It's a tool, but leverage removes time from the equation. An unleveraged investor can wait through a downturn. A leveraged investor might be correct about the long-term value of the asset and still lose it because the loan matures at the wrong time. We saw this dynamic during the global financial crisis. We've also seen it more recently in commercial real estate, where projects acquired using short-term floating rate debt became vulnerable when interest rates rise. Another important lesson from Sorkin's account is that financial crises are rarely caused by a single villain or a single decision. They emerge from a system in which the many participants respond rationally to their immediate incentives and collectively create an irrational outcome. A banker wants to make another loan. A broker wants to complete another transaction. An investor fears missing the opportunity. A politician doesn't want to interrupt prosperity, and the regulator hesitates to act without absolute proof. Each decision can be defended individually, and together they create a fragile environment. Sorkin also shows how attempts to restore confidence after the crash were undermined by the scale of the underlying problem. Public declarations and coordinated buying could support prices temporarily, but they couldn't repair the excessive leverage or restore the lost trust. You see, you can't solve a balance sheet problem with public relations. My criticism of the book is also connected to its greatest strength, because Sorkin focuses heavily on the personalities and dramatic events Readers seeking a technical economic analysis may want more discussion on, say, monetary policy, on deflation, on international trade, and the actual mechanisms that transformed a market crash into a prolonged depression. But this is primarily a human story, and on that level it succeeds. It really focuses on the psychology, the mindset that was in place at that time. So for real estate investors, the book 1929 is not a prediction that another identical crash is imminent. History does not repeat with precision. The asset classes change, the technology changes, the regulations change, but human behavior changes much more slowly. Yet the practical lesson is simple. Match the duration of your financing to the duration of the business plan. Maintain adequate reserves. Avoid structures that require perfect execution. The book 1929 is a timely readable and it's a worthwhile book. It reminds us that markets do not collapse merely because people become pessimistic. They collapse because the system becomes fragile, while nearly everyone was optimistic. So as you think about that, have an awesome rest of your day. Go out and get a copy of the book 1929, and we'll talk to you again tomorrow.